This episode is brought to you by Avalanche, the layer 1 that is blazingly fast, low cost, and eco-friendly. You'll hear more about Avalanche later in the show. All right, guys, we weekly roundup coming at you with a special guest today. We obviously have Santi, per usual. Santi back in the house. Looks like he did some home renovations, perhaps. I feel like this is a new blue background, but maybe he can tell me I'm wrong. And Byron, for those who read the Blockworks daily newsletter, we have the writer of the newsletter in the flesh, Mr. Byron. Forget how to pronounce your last name, Byron Gilliam or something like that. So, Byron, welcome to the show.
Close enough.
Good. Santi, new background?
It is new background. I love blue. I only wear blue most of the time, and so it had to be blue. But we also have the more traditional background of fake wallpaper, which I love. I've taken an affinity and appreciation for wallpaper.
All right, so here's the flow. We're going to talk about a couple things. FTX. We're going to talk about Terra and LUNA and this $1 billion Bitcoin raise. We're going to talk about NFTs. And actually, we're going to go back to the Coinbase hack, which obviously didn't happen this week, but last week or 2 weeks ago or whenever it was. But I just want to comment on it for a sec. And then at the very end, we'll just give some commentary on just kind of the state of the markets and things like that. But first things first, FTX. So here's what happened with FTX this week. This kind of went under the radar. FTX takes aim at the $300 billion luxury goods market and hires a beauty entrepreneur to head the push, right? FTX hired this woman, this great entrepreneur, Lauren Remington Platt, to work on partnerships with luxury and fashion brands. And this, to me, is, there's this amazing picture for those who are watching on YouTube. This is the picture that went out, which is just got to be the best photo shoot picture I have ever seen in my life. It's like they just grabbed Sam and said, "Sam, your photo shoot is right now." And he said, "Holy shit, I forgot we were doing a photo
Clearly
shoot."
Clearly the fashion expert is on the right, not on the left.
Yeah, fashion expert on the right.
He put some shoes on, so I would bet that he had no shoes on when they grabbed him for the photo shoot. He said, "Hold on, let me get ready."
Yeah. Exactly. So, all right, guys. So this is interesting to me for a couple of reasons. Let's just look at the progression of FTX for a second. FTX launches on the back of this successful Alameda trading firm they launched in 2019, I think it was. FTX first big acquisition was Blockfolio. Right, Edmund Cotta's company, Blockfolio, bought them for $150 million in I think it was mid-May of 2020, I want to say. Then FTX starts making a big push into sports teams, right? Retail. So Blockfolio, biggest retail app back then for just checking the prices. Then you had sports teams advertised obviously at the Super Bowl this year. They sponsored the Miami Heat Stadium or bought the Miami Heat Stadium naming rights. That's also retail, that's sports. Then they launched this NFT platform. Again, pretty retail focused. Then they signed up Giselle and Tom Brady. Now they get this beauty entrepreneur, Lauren Remington, to get into luxury and fashion and beauty, right? And my takeaway here is that FTX is just really, really, really prioritizing retail with some of these things. And specifically, actually, that they think maybe not just the spot markets are going to be huge for retail. So I think a lot of other folks are thinking retail and retail traders and the spot markets, but FTX is making a massive push, prioritizing retail. And, some other takes as well into where maybe they're going. But Byron and Santi, just want to get your takes on this big push into retail for FTX.
Well, maybe I'll go off and Byron, please jump in whenever. I think, crypto has and continues to be a retail phenomenon. We don't have a lot of front-facing consumer applications other than obviously the use case of trading but for the most part, most of the market continues to be retail driven. And if you look at the biggest empires that have been created in crypto have been, some like Binance, FTX. And so I think what's interesting now is when you layer on top of NFTs, I think NFTs have brought in a whole host of people that are more, it's a different crowd, right, that perhaps existed historically in crypto, where it was just kind of a pure trader, maybe more, I would argue the composition of mostly skewing probably male and kind of sophisticated around has the same people that kind of are on Robinhood, for instance. But with NFTs, I think a big part of this push into luxury has been NFTs. And it's impressive to see the volume of NFTs is not showing weakness, maybe recently, but it hasn't been showing weakness this year. NFTs have brought in a whole new type of crowd that naturally, I think you want to layer on a top other type of services that will match and expand and enter into the luxury, right? You see companies like Adidas and Gucci and a bunch of others that are now thinking about NFTs, and so I think that's where all this is going.
Yeah, Byron, give us your bear take, Byron, here.
Well, I have a bull take on that. I mean, I think they're going in the right direction. I think for crypto to go mainstream and get significantly bigger, it's going to have to be retail driven. Like one of the things that I've recently decided that is that I think that it seems like the crypto natives all make the assumption that as soon as TradFi gets the green light to invest in crypto, that there's going to be this tidal wave of investment, and that valuations are going to take this giant step change higher, and that the thing that's holding crypto back is just that, traditional asset managers are not allowed to invest in it. I'm feeling like that's not really the case. Like I think that if all asset managers had a full green light to invest in crypto right now, I think the flows would be really underwhelming. Because I think that they just would, there are just not that many investment options that would appeal to traditional asset managers. So I think FTX for that reason is one, going in the right direction, and two, doing the right thing for crypto as a whole. Because I think for crypto to get a lot bigger, it's going to have to be retail driven.
What do you mean by that there's not that many investment opportunities in crypto? Because obviously that's like the venture space is $33 billion worth of inflows on the venture side of things.
Yes. Yes. But we're getting the venture flows already. And I do think the venture capital is going to do very well. But that's like investing in the seed round and then selling the governance tokens, right? Like that is going to be an amazing investment case for a long time, I think. But in terms of looking at tokens the way that traditional asset managers would look at stocks, I don't think that they would love what they see. I think that crypto is going to be, structurally low margin for a long, long time, probably forever, which is great. That's like a really good thing for the world, but not a great thing if you're an investor, right? TradFi returns are mostly made by building moats and extracting rents, right? And there are just not a lot of moats in crypto, and there's not a lot of rent extraction, which again is fantastic. That makes it, a much better thing for the world. It just does not make it a much better thing for investors. And if if investors had a full green light to invest in crypto, I think they would look at it and be like, this is not what we're used to. These are not the moats, and these are not not the rent extraction that we're used to. And I don't think they would. I don't think there would be a tidal wave of money coming out of TradFi to invest in crypto.
Although I agree, like I think that's like how perhaps a more traditional investor might think. Like, it's moats in Web3 are very different than moats, I think, in Web2, and the ability to how you think about like value accrual and extraction is different. But like I've been talking increasingly. Like this week, I talked to one of the largest like concert venue ticketing / event venues company in Mexico. And they were like, okay, NFTs are interesting. I'm like, guys, like, fine, you make this money on just ticket sales, but NFTs, like, why wouldn't you issue tickets as NFTs? Like, it then allows you to capture a lot of this value from the secondary market that you're not capturing today. So, like, that would be, for instance, a new way to capture value. Or artists, right? They're minting these NFTs, and now they can make money on resales that perhaps they wouldn't have done before. I think, like, what I'm trying to say is that I think the value capture is going to be different. Or maybe the same, but it's just going to be distributed differently. Whereas perhaps historically, auction houses like Sotheby's and Christie's were the ones that made the most amount of money, or founders were the ones, and investors were the one that made the most amount of money, like for first investors in Uber or whatever. But now I think there's a redistribution of economics going to more towards creators. And yeah, Byron, like I think that naturally, for that reason, investment funds that have profited and made so much money off of Web2 and the way the venture is structured, is different, right? Or even TradFi investors, right, that are investing pre-IPO or IPO rounds. Like that's where most of the money gets made. These stupid like accreditation rules and all this stuff, but that's shifting, and I think a lot of that value trickles down, or not even trickles down. It's just going more directly to people like creators and or retail investors that are just closer and just participating in these networks.
Yeah, no, I agree with that. I just think that it's the value creation in crypto is going to be so different from TradFi that it's not really going to be crypto tokens taking money away from investment in the S&P 500. That's going to be retail money, and it's going to be crypto native money, and it's just going to be different.
Yeah. So this is a really interesting bet by FTX, right? Because I think when people look at most startups, it's like, yeah, in your third year, what should you be doing? Focus, focus, focus. Well, let's look at FTX's different business lines here. First, with the luxury market, right? FTX, this is a $300 billion luxury goods market, which folks are saying is going to grow by like 50 billion in the next couple of years. And we've been seeing fashion and beauty brands increasingly get into crypto, just as, the pandemic has forced people to get out of these brick and mortar stores and into like online and digital. And I think the thought is that this pushes these fashion and beauty stores even more into like the metaverse, right? So in February alone, some brands that filed for metaverse related trademarks, Victoria's Secret, L'Oreal, Kiehl's, Pink, right? Adidas, Nike, we talked about before. Like these are brands that are pushing heavily into the metaverse, and FTX wants to play a role in that. And I think when you look at so they have 5 areas of business. I think everyone thinks of FTX as this big trading firm, right? But really there's a lot more than that. First area of business, trading, like spot trading. They've got the fourth largest exchange by volume, right? So it goes Binance, OKX, Coinbase, and then FTX is creeping up on Coinbase. I think Coinbase is about 24-hour volume, like 5 billion, and FTX is about 3 billion. So that's the spot exchange. Then you've got derivatives, right? FTX is one of the only places in the US outside of like, I think CME Group probably, and maybe one other, where you can trade regulated derivatives in the US and not like VPN into somewhere else. And they did that through their acquisition of LedgerX. Then they've got the gaming division. The episode with Amy Wu comes out on Sunday. So in 2 days from now, the episode with Amy Wu comes out. It's really, really interesting. It's crazy how much FTX. So FTX this week also debuted FTX Gaming, right? Where really what they're offering, they spent over $1 billion on licensing in the last year. They're really offering a crypto as a service platform to help gaming companies launch tokens and offer these NFTs. Then you've got the NFT business where they launched an NFT marketplace trying to compete with Coinbase and OpenSea and things like that. And then they've got this white labeled business that barely anyone knows about, but that Amy shared some details on, where what they're trying to do is white label the entire FTX platform, custody, right, trading, lending, borrowing, all that kind of stuff into like fintech platforms like the Revoluts, Monzos, N26s of the world. So you got these 5 business models. It really does, to me, feel like FTX, like Sam is just very aware of market opportunities that could 100x from here, and he's trying to go after every single one of them. I'm not sure we've seen a startup ever in history blitz scale like this.
Amazon?
Amazon Blitz, they did it differently and they did it later, right? Like it took them, I think that's also because you didn't have the distribution pipes of the internet. Like they were still getting built while the internet was getting built concurrently, whereas FTX can leverage a lot of the distribution pipes of the internet. But yeah, Amazon started just with books, and it took them actually quite a while, I think, to get out into, how long did it take? Probably 15 years until they launched like their AWS business. Sam and what they're doing with FTX, this is like Amazon launching books and then 1 year later launching AWS is what it feels like to me.
I think like there's a really good book called The Everything Store. Fantastic about the history of Amazon. I think Amazon was at the brink of, it probably would have gone down had it not raised, had it not IPO'd or raised around like right before the crash. And it's kind of interesting to think about that. Obviously, to your point, Jason, like they started with a very narrow case of books, and most people were like just looking at that and focused on that, and then they've expanded to so many others, which has been pretty fascinating. And AWS has been a huge cash cow, but came years later, right? But you had to be, importantly, I think, in this environment where like a lot of people were just shouldering the costs, like the same way that you see in a lot of these startups in Web 2, like Ubers and Airbnbs of the world, like their unit economics kind of are not as solidified, and then the hope is that over time they become better business models and retain and like enter this flywheel. But I think largely those type of business models have succeeded because you've been in this environment of record low interest rates where people are just chasing yield and doing, loosening their discipline. I don't know if that would have been able to exist and these businesses would have been able to get off the ground had it not been for cheap venture money in the space. Now, the difference with FTX is it's a cash cow. When you look at like Binance, these exchanges like just print. And a lot of it's, again, it's retail, right? And so you're able to extract potentially like a higher fee. But these are just to your point, Jason, I think I would argue that FTX, I mean, it's unfair comparison to your point because of the internet. Like now you're leveraging a lot of distribution and the crypto phenomenon that, is using the rails of the internet, right? And there's less dependencies on that, but it's just been impressive. I remember meeting Sam in Hong Kong and he had Alameda at the time and he was like typically in his slouching in his like what do you call those like pillows, like the lazy boys, not lazy boys, but the beanbag. Yeah, he was in the beanbag. And it was like a super small office in Hong Kong and it was all empty. And he's like, I want to build an exchange, but I have no idea how to do that. And I don't have any expertise. And I said, I just had a feeling that he was just a savant. Like when I first listened to Vitalik and a few other people in crypto, like there are certain people that like operate at a different wavelength. And Sam struck me as someone like that. And at the time, Alameda was like doing the most amount of flow, like in some of these OTC markets in Bitcoin. And it was pretty impressive. And then I see 6 months later, after that interaction, I came away super impressed by his operation, but it felt like super small,
Yeah.
And then FTX launched, and that doesn't. It's not too long ago where that happened. That was like in peak bear market, like 2018. And that was Hong Kong. I was on my way to Binance conference, first conference in Singapore, and then they have just been relentlessly building, and I think it's, in my estimation, it's probably the best company in crypto.
Yeah.
Do you think he has a carefully modeled out idea on how FTX could make money in gaming or NFTs, or is it more like just he's going to do absolutely everything and see what works?
Yes, I think he does. And here's what I think. Here's what I think FTX is building. I think everyone thinks of them as a spot. I think everyone thinks of FTX as a trading exchange, as a trading company that is getting into other things. They are building an Amazon for tokens, right? If something, I think Sam's vision of the future is that everything will have a token, and he wants to be the place where those tokens are traded. If something has a token, he wants it traded on FTX, and he's basically building an Amazon for tokens. So I think what will come next, so you've got basically gaming, derivatives, trading, NFTs, and then this white labeled business thing to increase volumes, obviously. What will come next in my mind is stocks, like tokenized equities, which the regulations of that are kind of scary, but tokenized equities will come. And then after that, as cap tables of companies get tokenized and DAOs end up becoming a prevalent form of launching a company, they will launch a DAO service as well. I have no idea, I'm speculating here, but I think that will be the next two businesses that FTX gets into are tokenized equities and then something with DAOs. And I think their business model is just when you are a game, like with gaming specifically, Byron, if you are a gaming studio, they want the gaming studio to build the front end and every single other thing, the licensing, the middleware, the back end, the actual, the blockchain, all that kind of stuff, that should be supported by FTX gaming. So, and what's the business there? It's the Web 2 business where it's rent seeking, right?
Right. So is FTX like Web 2.5 then?
I think they're CeFi, and there are a lot of CeFi companies which are they're great. They've moved the industry forward, and honestly, jury's out on whether I think they'll all end up being massive businesses. Like Coinbase is a CeFi company, BlockFi, Gemini. These are CeFi companies. They are crypto. They operate in crypto, but they're not a 100% crypto native. They're not built on fully crypto rails. They're not decentralized. They didn't launch as a DAO. They probably don't hang out in the Discord, but they are crypto companies and they've done amazing things for the business. So I think there's TradFi, there's CeFi, and there's DeFi, and these are CeFi companies.
And is that good for a space as a whole? So FTX is going to advance, crypto gaming and NFTs, and then decentralized can take over at a later point, or are they just going to own the whole space?
I mean, mind you, FTX is one of the largest users of decentralized finance. It's absolutely good. I mean, how many people walk around the street? How many people do you think many of them have heard about Bitcoin? maybe other stuff, but none of them are using it. Now, I don't think everyone is prepared to like manage their own keys and venture into this sort of like this wild, fully decentralized environment. I think most people need hand holding, and they're going to probably go to someone like FTX, and that's fine. That's totally fine.
Yeah.
And so, look, I mean, Coinbase obviously has a Coinbase wallet, and they are allowing off ramps to L2s. I mean, ultimately, like, I think, I don't know, I'm not as concerned about, like, I don't want to dismiss this idea of, like, I'm very much an advocate of decentralization, but at the end of the day, like, you have hooks into decentralized protocols, and the settlement can happen, but a lot of the users and the user aggregation is going to be very much a centralized, for a lot of this market, centralized parties like FTX.
Yeah, I think
and that's net positive for everyone.
Yeah, I mean, you got to say Coinbase has been net positive. Obviously, they brought in 73 million people to use their platform, and I think FTX will do what Coinbase did, by the way, launching like a MetaMask competitor that's like an FTX wallet. I think the two interesting things about crypto are one, it gives you choice, right? So like I think most people will interact with crypto in a pretty centralized way, but you have the ability for the first time ever to operate, to kind of opt out of the system, the traditional system. And that's really powerful. And then the next thing is just like, it's an improvement of technology, right? Where like we're not building on ACH and Swift. And so even though we're just using, I don't know, Coinbase, which is like a centralized platform, it's 100x better experience than using my Bank of America or Chase account, right? So let's move past FTX. Lot to cover here. I want to get into Terra and Luna, and I'm going to lean on you guys here to help walk me through what really happened and why this is so important. So this week, Terra says Luna, the Luna token sale raised $1 billion for a Bitcoin reserve. Do you guys want me to take a stab at walking through this, or either of you guys, Byron? I'm not sure if you read about this a lot as you were prepping for the newsletter. If you want to walk us through what happened here and your thoughts, or I can take it.
I mean, the TLDR is just that he's collateralized UST with $1 billion of Bitcoin, right?
Exactly.
And the market liked that, I guess, because Luna was up 10% the next day or something. When I read that, I actually expected Luna to be down, but then I guess it kind of made sense that it was up, because to me it sounded like my knee-jerk reaction was like, oh, he's kind of throwing in the towel on the full tokenomics algo stablecoin, right? And conceding that he needs to collateralize it, which to me sounded like a negative, maybe. And also, my first thought was like, oh, well, now that's $1 billion of Luna that's going to get sold, but I guess it's like on a 4-year schedule or something like that. So I don't know. I kind of I kind of felt like it was maybe an admission that the pure tokenomics of Luna were not going to stand on their own. But the market clearly liked it. I guess it de-risks UST to a degree, but then it's also like it's only 10% collateralized. So I guess my next question is like, what happens now? Is it going to go to 80% collateralized? Is it going to become Frax, or is it just like is there a big difference between 0% collateralized and 10% collateralized? That doesn't seem like much of a difference to me. So where is it going now? Is it going to 80% collateralized?
That's a great point, Byron. Fantastic take, I actually think. Like algorithmic stablecoins are like fascinating from a game theoretical standpoint. Like, can they work? But like my interactions, like I was playing so much in ESD, DSD. Like I was an early investor of Basecoin way back in the day. They got shut down, never launched. Like they're fascinating, like experiments like simulate like a central bank. But at the end of the day, like my foregone conclusion in all these experiments is like largely they kind of don't work. They haven't worked, and you need to have like this hybrid like collateralized system. Frax has been probably the most successful in that. Obviously, the criticism around that is that it's using a lot like USDC, and so it's like, okay, well, it's not really decentralized. But still, it's like it has like the ability to like modulate the level of collateralization based on like as the market gets more conviction that this can work, then the level of the collateral ratio kind of dynamically adjusts based on how the market perceives the level of risk. I've always kind of wondered, and I'd be curious to get your take, is particularly in something like Frax, or you asked the question, okay, what is enough? Like, is 10% enough, or do you need to go to 80%, 90%, or 100%? And I think it's like a very interesting question. For Frax, like I was an early investor in Facts when I was at Parify, and I think Sam's like a really competent, like thoughtful guy. But I am wondering, like, if the idea is like you start at like 100% collateralized and then you go down as you prove out and as it becomes stable, right? But it felt to me like, you know, you're really kind of, it's like a known unknown. Like you might reach a level of collateralization that at some point you test it and you break. And once you break, the problem with these things is that once you break, you lose a lot of trust. And I argue that it's hard to recover from that. And a lot of it has been look at ESD and DSD. Now it's different, an unfair comparison, but I do think that like as it relates to like stablecoin, as soon as you break the peg, you lose a lot of trust. And I would think that, I'm curious if you think that like you ever recover from that fully. Now, obviously we've seen episodes where DAI's been under collateralized and, you know, March, and I didn't sleep for like a week trying to fix that. And we added USDC as collateral and maker, and that was contentious. And then you've seen USDC like lose its peg, largely an Oracle problem. But nonetheless, like I'm curious for these kind of hybrid or kind of algorithmic stablecoins. Do you think that like once you break the peg, do you ever recover from that?
Well, I mean, MIM broke its peg a few weeks ago, right? And it seemed to be no big deal at all, which surprised me. I thought it was going to be a lot more dramatic, but that might just be the way my TradFi brain works. But that is kind of the problem with the idea of a peg, is that it's binary, right? Like I think Jim Bianco had that good thread on stablecoins the other day, but one part of it that I didn't totally get was that he was like, for Tether, he was saying the collateralization doesn't matter because no one ever redeems it. Well, yeah, but it, you know, this is like, that's like saying, you know, in 2008 that the price of real estate, you know, the price of houses never go down because they never have. Well, yeah, they haven't until they have, right? So, yeah, the peg risk is always going to be a risk, even if it never happens, if that makes any sense.
What's your take on like these other flavors of stablecoin that say, well, let's not think of a peg as a binary thing. Let's just have floating based on some inflation or what have you, like float and some of these things, where it's like, you know, I think like the human brain and consumer behavior is very much tied to like, you want the certainty of a peg and you want the certainty of, you know, the USDC is $1 or what have you, or reference asset. But I am curious if you ever think that like these like more floating, like non-fixed peg stablecoins will ever kind of work.
I mean, I think there's loads of interesting experiments. Well, maybe not loads, a few. Like I think Sparax, I think, is really interesting. FPI, I think, is really interesting. So I think it's great that there are all of these different ones that we're experimenting with, and we're gonna figure out what works by trial and error. I even think the Ohm forks were like a really worthwhile effort, even though they kind of, you know, they look bad in hindsight and they're easily labeled Ponzi's or whatever. But I think it was like a really good thing to try to figure out. You know, figure out if you can create a reserve currency that's based on, you know, crypto native assets. I don't know, but which ones did you have in mind?
The one that I'm close to, and you know, full disclosure, I was invested in, as I found the team pretty thoughtful, is Float, which is saying let's just make it bit anchored on some sort of reference like inflation or what have you, or purchasing price index or whatever, which I think is interesting. I'm not sure I truly believe that will ever become like a massive market.
Stablecoin, Santi, if I understand that correctly.
Yeah, it's floating.
Okay.
It's
I don't know much about float.
Yeah, exactly.
But I mean, it sounds like it's pegged. It's just pegged to something else.
It's pegged to something else, but it has more leniency to like adjust. And it's the same with like okay, NFTs, right? You think of NFTs, the floor of NFTs are priced in ETH, and so that's fluctuating, right? But still, okay, it's pegged to whatever ETH as a reference asset, but the value of that pretty much changes, right? And so, whereas I think it's more of like the psychological perception. Like you always want the certainty of like what things are worth, and it's difficult sometimes to then think about stuff in not fixed terms. Obviously, you could argue in the metaverse that might work, which is like you're pricing stuff in an economy in ETH terms. Now, of course, ETH is a volatile asset, so, but still, you don't necessarily think like that because you purchase these NFTs first of all in ETH basis. So you're thinking of that in ETH terms, not like US terms.
All right, friends, quick break to share some exciting updates from Avalanche, one of the leading L1s. First, the Particle NFT sale, powered by Avalanche. Particle has fractionalized high-end art into 10,000 NFTs, the first piece being Banksy's Love is in the Air. Check it out, particlecollection.com. Number 2, an ILO, initial litigation offering, has started on Avalanche in partnership with Rival with a Y, a community fundraising platform for court cases. Really interesting use case there. Number 3, enterprise partnerships growing on Avalanche. Deloitte recently partnered with them to optimize logistics around natural disaster relief and claims payouts. MasterCard also tapped them to help accelerate crypto startups. Number 4, last but not least, I got an early look at a report from the Crypto Carbon Ratings Institute that shows the energy usage of various L1s. Avalanche came out very low in terms of total energy usage relative to other L1s. Thank you, Avalanche. Big thanks for sponsoring Empire. Now, let's get back to the show. So let's bring this back into Terra, because I think there are a couple more interesting things. I think there are some other interesting things here. Like, one is we've seen pretty much stablecoins need two things, right? They need reserves and they need demand. And Byron, you mentioned Ohm and their forks. Ohm started with the reserves. And so you can either start with the reserves or you can start with the demand, right? And Ohm kind of started with the reserves. And they said, how can we get people to deposit to build our reserves? And they had obviously different models and basically like giving people money and yield to build up the reserves. And that model of starting with the reserves, I mean, it's all a big experiment, but maybe it doesn't work that well. Terra did the opposite. Instead of starting with the reserves, they started with the demand, right? They partnered with folks like Chai and things like that. And I think the issue has always been this Luna death spiral, right? And like, how do you collateralize it? So basically, I think the death spiral is that if Luna goes down, it can death spiral because it can be redeemed for $1, right? A broader bear market causes Luna to fall in value. UST holders fear the peg breaks and sell their UST. More Luna gets minted, leading to further price decline. And I think that Terra's thought by raising $1 billion here is that this should hopefully provide an additional avenue to maintain the peg in these kind of contractionary cycles that we're in, which will reduce the reflexivity of the system if you've got $1 billion backing it up. And then I think it's interesting that they raised $1 billion in Bitcoin and not in USDC, because that is the best way to actually create a decentralized stablecoin, because obviously USDC is reliant on still fiat and still the US dollar. So raising in Bitcoin is probably the best way to maintain this, actually build this decentralized stablecoin. So I don't know. Do you guys think this is do you guys think this works? Do you guys think, what are your thoughts on just how this impacts this hypothetical death spiral and UST's adoption and all this kind of good stuff?
Look, I mean, I think all of these are experiments, and they're constantly, every incremental kind of shock that these things are able to absorb and withstand, it gives you higher certainty that, like everything, greater Lindy. I think the issue that I've had with a lot of just stable coins, like non-collateralized stable coins, that they're mostly like Ponzonomics, and then they typically break and people lose interest and move on to the next higher yielding kind of Ponzi. But what's interesting about Terra is that it has underlying demand that is non-speculative, meaning for e-commerce. Like you look at Chai, and that's always been kind of the thing that I monitor the most. Ultimately, these stablecoins need to have non-speculative use cases. And I think Terra probably is the one that has the most out of all of them. And so I think that's ultimately what you need for these things to be successful. Otherwise, they're just another farm. They're just another way to earn attract a lot of speculators, which is really fragile. It's just, when I look at that, I'm very skeptical. I need to see underlying non-speculative demand for a stable coin to then get conviction that it might work.
I think that was the whole idea behind Luna, was that he used some clever tokenomics to buy time while he built an ecosystem that would create enough natural demand for UST, right? So, pre this mini collateralization, it was basically UST was collateralizing Luna and Luna was collateralizing UST, which is, I don't know what that's like, lifting yourself up by your own bootstraps or something like that. So like when I saw the collateralization news, I kind of took that as like, okay, the ecosystem is not developing fast enough to create the organic demand. So now he's trying to buy some more time with this Bitcoin collateralization.
Yeah, my take on this is incredibly good for Terra and the whole ecosystem in Luna as well, right? Because now the biggest problem, like the main reason that these decentralized stables and like seniorage based stables have not worked in the past is because of the of this like death spiral. And so, but now instead of being required to mint Luna to arbitrage the UST prices, you can now swap UST to BTC instead. And so now like the largest risk for the peg has been minimized. And that's, I think that just like, A, it's important for the long-term sustainability, but B, it decreases the psychological resistance to using UST over what others perceive to be like safer stablecoin options, like maybe a USDC or something like that. So I don't know. I think also just like by having the ability to swap into BTC now, you no longer have to print more Luna, which then will bring value to Luna because you don't have to, in times of contraction, you don't have to, there's less Luna that gets minted into circulation. So I think this was a really smart move. NFTs, another big month. This was an interesting chart in my mind. This is Ethereum sale, just like Ethereum sales and Ethereum volume, basically. And what you're looking at is the black line here shows the number of unique buyers, and the blue line is the number of unique sales. So actually, since like September or maybe November, the number of unique the number of sales, total sales, is actually staying decently flat. Maybe it's up a little bit, but the number of unique buyers continues to climb month over month. And so I don't know, I was having this debate with Mike last night, like, are we bullish or are we bearish on NFTs right now? And the bullish arguments, there's a lot of bullish arguments. One, you could say that the Coinbase NFT marketplace, like there's over 1 million, I think, users on the wait list already. That's not baked in probably. Another bullish thing, gaming NFTs are coming this year. That's really bullish. Another thing, the total NFT market cap is still microscopic. It's like 20 billion compared to 1.8 trillion for the spot crypto market. And that just seems too small to me. So that's really bullish. On the other hand, it feels like every area of the market has pretty much popped and has like retracted maybe 50, 60, 70%, except for NFTs. So Santi, I'd go to you first. Where are we in the NFT market cycle?
Oh man, I mean, is there even a cycle? Like, I mean, I don't. NFTs are like collectible markets. Of course, I think there has been a lot of speculation. A lot of people that are like borrowing against their ETH to buy NFTs and play this NFT drop musical chair games. Like I've inspected a lot of wallets. A lot of them are using leverage to buy liquid assets. I'm like, they just never will end well. We'll see. I mean, it's been pretty impressive. The volume, some of these floors have held up pretty well. On one end, like on a more secular basis, I think NFTs have captured the imagination. It was so in your face last year that I think like NFTs are not going away. There's a lot of the quality is probably going to go up as you see more higher quality brands have a strategy. You might buy a physical item, you might get printed an NFT. But I do worry, like, I think right now in this market condition, you're going to be testing a lot of the illiquidity. Like what people are going to learn the hard way, what an illiquid asset looks like. And you trying to sell an illiquid asset in this market environment is going to be very painful. And so I just, for a while, I've been cautious about NFTs. Like I'm not, from a speculative standpoint, I see a lot of speculation. And I think these floors are going to, for a lot of these, are going to collapse. Like there's just too much supply. And honestly, a lot of these projects are just, I don't know, pretty low quality from in my estimation. But look, it's just one man's opinion. Like, I don't know. I'm not an art expert.
Is there any risk to the rest of crypto if the lower quality half of the NFT space just collapses? Will that matter for crypto?
I think it does set us back on the margin, right? Because it's like new users. A lot of the NFT market is different user base than perhaps the more like sophisticated trader, like, you know. But it sets us back, of course.
Byron, what are your thoughts on the NFT market right now? I feel like you just started dabbling.
I have only just started dabbling. It is a lot of fun, is one thought. Uh, it has been sort of minimally correlated to the rest of crypto, which is a good thing. But I do wonder like how sustainable that is. I mean a large part of that I think is just because they're so hard to sell, right? When markets go down and you're losing money, you sell what you can, and your NFT is probably not one of those things, right? There's either no bid or a very low bid for it, which is also kind of, which can also be a good thing. Like half of my personal investment portfolio is in property, largely because I can't sell it. I can't panic out of it at the lows, which is excellent because I'm prone to panic out of things at the lows. So I actually think that's a feature, not a flaw of NFTs. But if people are getting leveraged in it and stuff, then that could obviously end badly.
Yeah.
I guess Santiago just touched on it, but one question I have is like how much of an overlap there is between NFT owners and the rest of crypto, because it definitely seems like there are different users and different objectives and different use cases for NFTs, and to the degree that there is less overlap between NFTs and cryptos than in crypto generally, then that is a bull case for NFTs, I think.
One of the interesting things that comes to NFT, I'm actually still quite bullish on NFTs from here. I mean, the Coinbase marketplace is really, I don't think it's priced in. Gaming NFTs are coming this year. And then also I had lunch yesterday with this team from Bridge Split. It's basically, they're helping, they raised from like, who was it, like Packy McCormick and Solana, Coinbase, Jump, CoinFund. They're helping to just improve like financialization of NFTs. There's $20 billion worth of NFTs right now sitting kind of idle in wallets. You can't lend against them. You can't really, they're these like dead assets. And I think that folks like Bridge Split and Fractional and people like that will make these like real financial assets that you can lend against, borrow against. And I think that's just good for the market. So
that's what they said about CLOs and CDOs and everything in 2008, right?
I will say I was sitting there at this lunch yesterday being like, all right, so we've got NFTs, we've got fractionalized fractions of the fraction of the NFTs, and then we put derivatives on top of these NFTs. I'm like, oh boy.
There's a fine line between capital efficiency and capital disaster.
Yeah, exactly. All right, one of the last things I want to talk about is just this Coinbase hack. I just think this was a wild story that got like barely any attention. Obviously, like shout out to who's the white hat hacker, Tree of Alpha on Twitter. Just like, I don't know. Did either of you guys follow that closely? This hack? I mean, this thing
that guy's definitely underpaid.
Yeah, I mean, 250K probably should have gotten paid more, but like, I mean, this thing could have tanked the market 60%. Like if this happened, like this, I don't know. I just feel like this should have gotten more attention.
Was there a limit to how many Bitcoin he could have sold? I know. I mean, I read that he was going to be able to just naked sell Bitcoin without anything against it. But was there any indication of how much could he infinity Bitcoin?
I mean, he said that he could have traded like it could have been a multi-billion-dollar bug, but he didn't do it. So
grossly underpaid.
Yeah, grossly underpaid, but that's all right. I think here's my take. So OpenSea also got hacked this week, or it wasn't like
I don't know if it was hacked. Actually, it felt like more. I think it was a phishing accident on 32 users.
Yeah, that's the wrong thing to say, is that OpenSea got hacked. The hacker used this helper contract to call an OpenSea contract that was deployed like 4 years ago, but it was a phishing attack. I think the take here, though, is that like the security of a lot of these crypto platforms now depends entirely on wallets that have pretty universally poor security UX, and there's very little that the platforms like the OpenSeas can do about it. So OpenSea, like the OpenSeas of the world, are they can build this amazing platform, but they're entirely dependent on a lot of the wallets out there right now. And I think just like there's this guy Dmitry Tokarev, he's the CEO of Copper. And Copper, he spoke at our DAS London event, and he said this thing that stuck with me, which is like crypto has grown 10x really, really quickly in the last 12 months, but the security has not grown 10x. And so I think just Coinbase, OpenSea, a lot of these things, Wormhole, right? These are all reminders that like things break when you grow too quickly, and like we do need to spend more time focusing on just security and stuff like that.
Security is a lot of things. What do you mean by security? Talking about like personal security, like okay, it's incumbent on users to understand like security, right? Like everything, you could have a really robust
No,
security.
sorry, actually, I disagree. Sorry, I
No,
disagree.
no,
with
hold
you.
on, wait a minute. Like
Yeah.
you can go on Gmail. If you're not using a password manager, if you're using your birthday or some sort of identifiable piece of information like password 1234, I'm sorry, but that's on you. So
I
like,
shouldn't be doing that. 1, 2, 3, 4. No,
no,
I agree.
well,
Yeah, I agree.
you know what I mean? Like the thing about this space is there are protocols, there are best practices in security. Whether you want to follow them or not, that's on you. And this space transfers a lot of responsibility over to the user, a lot of which are not prepared for that. And so that I'll push back because look, you either learn it the hard way, and it's a little bit like flood insurance. Most people may start with a small amount. Imagine if you invest in the ICO of Ethereum and you put in 20,000. That 20,000 is now worth millions. Your security practices should go up in line with the value of your portfolio. And so like I'll push back on that. Now, are we perfect? No, I agree with you. There should be better key management solutions. There should be better education and awareness. And there are some contracts. I think OpenSea like is migrating contracts to make them like, okay, like when you're signing a transaction from like, perhaps a ledger or something, like readable data that might simulate the transaction before it goes through to understand like, what things are actually happening before they do. So I'm excited about that. I invested in a protocol called a company called Chaos Labs that is kind of like Gauntlet, but like simulating a lot of these smart contracts and protocol upgrades to allow teams to say, okay, we're going to upgrade, say, Aave v2.v3. Before deploying it, you can simulate and stress test a lot of these variables and like new protocol changes. So like I agree with you. I'm not like, but I think it's like always important to say like users should like take the time to like beef up their security practices. Like I think there was a survey by Punk 6259, I think, my hoodie brother, and like most people don't even have a hardware wallet. Like, okay, like if you don't have a hardware wallet, and by the way, anyone listening, go get a hardware wallet today. Unless you have like less than like $1,000, even like, okay, like a hardware wallet's like $80 or so. I'm investing in this company called OneKey, which is like going to do a hardware wallet for like $20. Literally just in a form function of like a super nice and slick like iPod mini of sorts. Go get a goddamn hardware wallet.
Okay? That wouldn't have helped the person who got fished in OpenSea though, right?
No, I agree. Totally. Like if you get fished, like that's very well, yes, because irrespective of that, like if you're signing a transaction and it could be blind signing, then you allow someone else to just call that contract and, transfer those NFTs in your wallet to another wallet. That's what ended up happening here. So, but blind signing was, I think, it would have been interesting, and I'm not an expert here, but it would have been perhaps if you would have understood what you're signing, what you're actually signing, and the permissions that you're giving based on that signature, then perhaps you wouldn't have done it. And I think that this is where OpenSea is migrating a different standard to protect users, at least to give them a greater level of awareness of what they're signing. Because most people just are signing and like literally clicking. I mean, if you're clicking and signing so many transactions per day, at some point, you kind of like most of the time like become like less paranoid about what you're signing. It's just like, oh, another signature. Oh, it's in my workflow, and it becomes behavioral and habitual. And it's like, oh, it's just another signature. It's OpenSea, and like boom, but it's just one bad click and you're done. Like, and that's scary. And I agree.
So does OpenSea have some culpability here?
I actually don't know, and I don't think they do. A lot of people came out very quickly saying, is OpenSea going to like reimburse? But in this case, I mean, if it's a phishing attack, like, I don't know, could they have done things better? Do you think that there's culpability here on OpenSea side?
I don't think so personally. I haven't gone that deep into the details, so I probably shouldn't even express it.
There was a great thread by Nadav, who used to be at Dharma, and now is at OpenSea. He's the CTO of OpenSea, and so we'll link it in the show notes. But I think he probably was a very balanced. He's like sharing a technical rundown of the phishing attack of OpenSea. He said, look, even though it appears the attack was made from outside OpenSea, we're actively helping affected users. I don't think it's an admission of guilt. I think it's just doing the right thing. And so they're definitely calling an OpenSea contract, obviously, but you know, once you sign something, you give permission to someone, but that's not OpenSea's fault. He does talk about like prior to the current phishing scam, part of why we elected to implement EIP 712 on the new contract is that EIP 712 type data feature makes it much more difficult for bad actors to trick someone into signing an order without realizing it. For example, if you are signing a message to join a whitelist, a raffle, or a token-gated Discord group, and you're presented with a type data payload referencing Wyvern, the protocol used by OpenSea, it is much more likely to alert you, like this new EIP 712 is much more likely to alert you to something unusual going on. So, okay, could they have implemented EIP 712 earlier? Would that have mitigated this phishing attack? Not really. I mean, ultimately, you can help the user by alerting, so this EIP makes it much more difficult for people to blind sign, which I think is a big problem, right? I mean, I think like even like sophisticated people like the Nexus Mutual founder, Hugh, which he was super sophisticated. I mean, he's a sophisticated guy. There was a fake MetaMask deployment he was using a hardware wallet. And if you remember, he was going on Nexus, his flow was the same, but you know, he signed a transaction that diverted and just was calling a different type of contract that I think drained his account. And it was really, I mean, sadly, it was because all of this could have been mitigated. He was using a hardware wallet. All of it could have been mitigated if he inspected the contract that he was calling, right? Anytime you sign a transaction, you can go in there, like there's a best practice. And he has a great thread about it. These are my learnings. Had I clicked on the type of contract, I would have known that this was like a malicious contract. And so
could a normal user click on a contract?
Absolutely, man. When you're signing MetaMask, you know exactly which contract.
Okay. So you double check every contract every time.
Anytime you're signing a transaction, go look at the contract. Always. When you're giving permission, go look at the contract and understand what that contract is doing. Or at least like say if that contract like it's like two things that I really like. MetaMask now allows you to nickname a particular contract. So if you're using Uniswap, you're using SushiSwap, whatever protocol you're using a lot, just add a nick. The same way that you have a bookmark in your browser, you can kind of add a bookmark to a contract. So if your MetaMask client gets compromised because you click a link and whatever, and if you're going to go back to Uniswap and you're going to click on in a contract that you never used before, then it's going to show very clearly because it's not nicknamed, whitelisted, like bookmarked. So MetaMask, that's a new feature of MetaMask. That's great. And so definitely like add those nicknames to contracts that you're using frequently. And when you're using a new contract, like when you're calling a new contract because you're going on a new protocol or like a new NFT drop or whatever, or a farm, inspect the contract. And if you're not a security expert and you don't know how to read a contract, well, go to the Discord and at least ask. Or even tweet, be like, hey guys, I don't know what I'm signing to. Like, has anyone used this contract before? And I think the nice thing about this space is there's a lot of white hackers out there. If you tweet, hey guys, I'm going to use it. Has anyone been on this site and called this contract? I don't know what it's doing. Can someone help me? Man, I guarantee you're going to get responses within 5-10 minutes because people genuinely in this space are out there to look out for each other. And so that's all. I mean, we should at some point link to some great resources like My Crypto, like Tay, fantastic. I mean, she's one of the best people out there in the space. She is always calling bullshit and like making sure people understand what they're doing and raising awareness and education. Nadav's thread is great. Like there are just best practices, and it's just honestly most hacks that I've observed, absent like key like obviously like rug pulls and bad code like at the protocol level, which has happened, like Oracle problems like that. I understand like that's problematic. I think we should always be very careful around that. But most other hacks, especially in the NFT land, has been like seed phrases being compromised because people are not using hardware wallets and using hot wallets, or are not taking the time to understand what they're signing. And we just need better education on that. Like there's just no, man, if you have a Bored Ape that's like the floor is 100 ETH, like, all right, man, like beef up your security. You should always understand that people, it's not a question of, I think like who was it said it? It was not a very comforting answer. It's like, it's not a matter of like, if you will hacked, if you're going to get hacked, it's a matter of like, are you important enough to be hacked? You should always
said that, I think, or Mike Dudas or something like that.
Someone said this. Yeah. I don't know, but it was like Hillary Clinton. Obviously, when she got compromised, it's like, yeah, like if you're a politician like that, if you're a reporter, like you just know that you're a high profile individual. And like likewise, if you have a wallet that has meaningful value, like you're a target. So just be careful.
But crypto's gonna have to get a lot more dummy proof than that if it's ever gonna go mainstream.
But I think there are people are rolling out dummy proof ways. Like Coinbase launched Coinbase Vaults, right? So like you can have a multi-sig within Coinbase basically. Like you can turn on, like let's say Byron, you have X amount of money at Coinbase, you can put that into your Coinbase Vault, and then if you ever want to take it out of the Coinbase Vault, you can add you would basically add people as like signees to the vault. So you could add like 4 other people, and if you ever needed to take it out, you'd have to like text your sister and your mom or something like that to sign on it. So, or your dad and your brother, whoever it may be, trusted people in your life.
Yeah,
so
I would never trust my sister and my mom with that.
I actually think
Byron, Byron, that's not a problem with crypto, sir. That's something else. I'm sorry to break it.
I think most problems in crypto end up coming not from like these these malicious hackers, but from just like people's personal just moving too quickly. Like Byron, you lost some crypto. You lost your seed phrase, I'm pretty sure, if I remember correctly. Or like I
lost my Luna seed phrase. Yep.
Oh, that's why you didn't want to talk about Luna today. So salty. So salty.
It wasn't that. It was a medium expensive lesson, so it wasn't.
I did the stupidest thing the other day. I sent USDC from somewhere to somewhere on different networks. Like I sent like a USDC on ETH to like USDC on, I forget what it was, on Solana or something like that.
Could you have done that though? Like because typically it doesn't recognize it as a valid. Like the taxonomy of the address of Solana is different.
If you are sending it from like a Coinbase to a Gemini or something like that, they have like preventions in place. But I was using less like built out platforms like that. Yeah.
I was gonna want to transition into obviously like, okay, macro is day like today, you know, crypto markets are down substantially. There's obviously a situation in Ukraine which is super unfortunate. And look, I mean, I think we're not. It's very saddening. I'm quite sad today, like that we have wars in 2022. But you know, there's no hot takes here other than like it's a very unfortunate situation. Obviously, crypto markets are super correlated and are risk-on assets, and there's a shock. But like someone asked me this question yesterday. I was at another podcast, and I was on the other side, and I kind of developed this framework, which is like, everyone's like, okay, do you think crypto dies? Like, what happens to crypto in this environment? Like, there's all these kind of simulations that you can do in your brain, but like, I pushed back and I said, look, the biggest risk of this industry, Byron, this kind of alludes to what you were saying earlier, is not so much like an exogenous shock to this industry. It's more so self-sabotage within this industry. Like, there's a lot that we can do as an industry. I think the biggest risk of crypto derailing and setting this industry adoption and success back is just stuff that we can control. Like, you know, the wormhole hack would have like set us, it had Jump not bailed us out, that would have set us back years. Solana could have gone down. Like, now, could we have mitigated that? there could have been things that we, I think that's where we need to be super critical. Instead of pontificating on macro and like Swift and like the circumvention of Swift using Bitcoin rails, and the geopolitical chessboard is something that none of us, I'm not an expert, and none of us can control. It's certainly interesting because macro and like Bitcoin and like this is sort of the purpose of, I think, like if you read The Sovereign Individual, it's very interesting to think about crypto in this like multi-generational transformation of a redistribution of power and power to the individual and self-sovereignty and all this stuff. But like that is kind of like, it's a beaten horse. Like everyone talks about that. Not a lot of people talk about, okay, what is the stuff that we are not doing great as an industry? Because there's a lot of bullshit in this industry. There's a lot of things we can improve. And I think it's incumbent upon us to like mitigate this too big to fail. Like bridges, yeah, they pose a increasingly systemic risk to a lot of like the interconnectedness in the surface area is ever expanding, and we need better insurance products. Like we need insurance on bridges, we need insurance on deposits, we need insurance on all kinds of stuff. And until we have that, this industry is not going to grow as much. And that is the number one handicap. And so like spend less time thinking about, like obviously it's super important to like, we're in a state of the world, it's fragile, like, but still, as an industry, I think the biggest risk is not an exogenous shock, is something blowing up. And I think we need to be super focused, especially as more users come, to make it easy on them and to secure them. Because if we have another wormhole of stuff and we don't survive that, I'm sorry, but that's going to set us back years. Like, we're done. Game over. Go home.
Yeah. Yeah, I completely agree. I think let's wrap this up by saying I think we purposefully didn't try to pretend like we were geopolitical experts here talking about Russia and Ukraine, but and it feels kind of just goofy to say thoughts and prayers, but like, yeah, I mean, I think it's I don't want to try to weigh in too much, and I think that people should probably just do something nice for someone else today, and yeah, honestly, just thinking about people out in Ukraine, and yeah, I think that's a good place to wrap it.
I agree, man. Byron, thanks for coming on. And I know there's a lot of really smart devs and teams that are based in Ukraine. Hopefully everything's okay there. And if there's any way that we can do to help, please let us know.
Agreed. All right, everyone. Be well. Enjoy the weekend. Enjoy your Friday. And we will see you next week.